Alright guys, I wanted to do a video, a little more mindset this time before we get into any fancier indicators or fancier trading plans. And honestly, if you've seen my prior two videos, I don't get much fancier than that. I have a very simple trading method and I use pretty simple indicators. I'll post charts with a lot of noise on them, and I just call them noise, with different levels and channels and whatnot. And that's fun to do to try to figure out where things may be going in the future or try to guess ahead of time. But honestly, the way I trade, it really doesn't matter which way price is going. It matters how I react when it starts to go that way. So trying to predict the next big move really means very little to me. Anyway, we'll get into that too. But let's start with kind of the first step of planning is what type of trader are you? Because I just went over a little bit over what I am, and we'll get more into that later, and you guys have seen some examples of that. But you got to figure out what type of trader you are. If you don't have a lot of time to check the charts and map things out, set aside some time on the weekends, look at the bigger charts, and use smaller leverage over longer periods of time. And that's the hardest part, is going to be identifying the trend for you guys. Those are swing trades, right? You guys are going to be the ones trying to figure out where price is going to go over the next few weeks, over the next few months. Are we in a bull trend or a bear trend? You can trade very successfully that way. You just have to know that that's your speed. And if you're obsessed with checking the charts and checking the price multiple times a day or every day, swing trading may not be for you. Because if you're checking price every day, you're going to get bored with swing trading. You're going to get tired of waiting for price to go your direction. You're going to sit in a loss for days at a time, quite likely, before things really take off. And if you can't handle that, it takes a particular mental aptitude to handle that. Swing trading may not be for you. It sounds relaxing, and once things start going your way, it is relaxing. But until then, it can be a headache. We got the other end of the extreme, and that's the scalper, right? And the scalper is in and out in a couple of minutes. In fact, I just did a quick little scalp on Polkadot. It took me 5 minutes, 30%. Might have been a little higher than that. I'll have to look it up, but it was about 30%. It was just a little move. But I watched it the entire time. It was, it still gets me a little bit if I'm sitting watching it. I put in another one, and I left this one alone. I've got the stop loss, I've got my targets, and I was like, you know what, I know I'm bored tonight. I'm going to record a video instead of sit and watch this trade. It's going to do what it's going to do, and it's a small trade. Because, well, for one, it's the weekend, 2, it's at night, and 3, I'm not watching it. So it's a very small amount of capital that I threw in there. I'm trying to work on my entries. It's part of my training and practice as well. I mean, I still do trades for practice. I mean, this position, I think I'm looking to gain maximum. If it hits my take profit, it's $20. I mean, that's it. So, yeah, small trade, small practice. And I think that's one of the great things with scalping. And everyone should really try it once or twice, where they dive into the 1 minute or the 5 minute, and just, even if you're not putting money in it, just look at the chart and say, all right, we're going up. See, let's say we have a resistance line here. I would take my entry there and then watch it hit. And if it goes down, you're like, oh man, I had a good entry there. And it comes down, and say it goes through the first support level you had and hits the second one. You're like, okay, so there's a good move, went down through support level, and it's doing this. I'll say, I think it's on good solid support, and it's going to make a W, so I'm gonna go in there, or maybe I'll go along here and see what happens. And you don't have to do that with money. You can just write it down on your charts, or write it in a notebook. Keep a journal, a trade journal. I can't actually stress that enough, to where you're holding yourself accountable for the trades that you take, even if they're not real trades, even if they're just fake paper trades. And I want to say there's I think Bybit has a fake trading option where you can put fake funds into an account. I haven't done it. I'm old school. Back in my day, we just wrote it in a journal. I got a notepad and a pen, and I wrote down what my entry would have been, what my stop loss would have been, and then I checked the chart from that point, and I let myself know if we hit the target or hit the stop. And of course, I didn't use this small of a time frame either back then. So nowadays, it's easy. You hop into those minute charts, and it just reports. But anyway, I'm rambling on, digressing. You guys can tell I like scalping. I'm going to stop talking about it now for just a minute, and we'll start talking about let's do day trading. I just went all over. Right. So day trading is probably the most common, and it's that great middle ground between scalping and swing trading. You can be an intraday where you're in at the beginning of the day and out at the end where it's a few hours, or you could go over the course of maybe a week even, at the longer end. You're going to be in for multiple days, and you're looking for bigger moves. You're not looking for huge swing moves, and but you want something bigger than your typical scalp. So in that case, instead of the low leverage swing, and I don't know what everyone else's plan for swings is. When I swing trade, I'm somewhere between 2 and 5x leverage. That's it. 5x is the tops for me. For scalping, I typically play between 30 to 50. For day trades, 10, 15, that's pretty good. I find when I go more than 15% or 15x on a day trade, I run into more trouble than it's worth. So 10 to 15x for me for day trades is perfectly fine. It's a good amount of leverage without really throwing yourself into too much risk. And you can go lower, 5, 8x, that's fine too. It just depends on how much of your portfolio you want to put in. The other thing I would recommend you do, especially starting out, if you're looking to take some of your first trades, is to not be tempted to use cross margin, even if your account is small. So the difference between cross margin and isolated margin is isolated will place the amount of money that you have in the trade at risk, versus cross margin, which places the amount of money you have in your account at risk. Isolated margin, if you get stopped out, say you get liquidated without putting a stop loss, they'll send you the nasty red email and a text saying add to your liquidation, or buy back your margin and all that. But in the end, it doesn't matter. Well, whatever your liquidation amount is, that's all that's going to get liquidated, is the amount that you put in the trade. Versus cross margin, which does give you a wider availability of stop loss, but the danger of that is that you will be tempted to ride that stop and add margin to your account, and just in the hopes and prayers that it will turn around. And I'm not a fan of that option at all. Because just when you think you know what price is going to do, it'll turn and do the other thing. Now let's say we were playing this, right? And we got a nice W, right? And I hit here, and this is my target up here. I roll over, and I didn't set a stop loss. I've got cross margin. My stop loss is down here. I'm like, well, let me just cancel that stop loss because I don't want to take the hit. I don't want to see the red numbers when I close the trade. And I just just keeps going down. Now it's doing this, right? And I'm thinking to myself, well, maybe it'll turn around here, and it won't be so bad. What are you going to do when price goes further down? How much longer are you going to chase it? How much more liquidity are you going to commit to this move? You know? Before you call it quits. And at that point, you're not just riding a bad trade. And you can get, if you're adding margin to your account, you're buying a bad trade. You're shoveling money out of your account and giving it to someone else. So I'm not a fan of that. Set your stop losses. Take your stops. If you find you get stopped out too often, your stops are probably too conservative, or your entries are not, as tight as your stop losses would have them be. If your stop loss is here, really low, then your entry should be on confirmation. If your stop loss is a little further down, you probably want to enter it a little closer. Maybe you're a bit of a sniper with your entry, but stick to your plan. Make a plan when you trade and stick to it. We'll go over some of that as well. But yeah, practice all three. You won't get a lot of practice out of swing trade just because they don't happen very often. You'll get a little bit of practice out of the day trades. You should be able to hit 1 or 2 day trades, maybe 3 day trades a week. That's a good number. If you're doing more than that, you're probably intraday trading. And if you're doing more than 5 or 7 intraday trades on the same token, you're probably a scalper. Maybe you need that adrenaline rush. Maybe you just you like to be that active. You like to feel like you're doing something. Or maybe you're doing a combo of all three. But again, it's important to know which one you're taking the trade in. If you're taking a swing trade, make it a swing trade. Don't try to turn that into a scalp. It'll end badly. Well, maybe not so much in that direction, but if you try to turn a scalp into a swing trade, it'll definitely end badly. That's where it gets dangerous. Alright, so move on from there. Once you got an idea of what type of trader you'd like to start being, or say you've got some experience, you know what you're into, maybe 1 or 2 different types of trades, or you just know what your different trades are. You could be all 3, that's fine. And we need to plan your accounts out, right? And I am not a financial planner by any means, but you're going to want something long-term, a long-term investment portfolio that you can take profit out of your trades and start moving them here into your long-term investments. And if you don't have these 3 set up, mid-term holdings and short-term trades, well, this is what we're talking about learning here, is the short-term trades. And you want to take the profits from your short-term trades, and I recommend that if you have a good trade, you start with your $10, and let's say over the course of a couple of weeks of practicing, you turn that $10 into $100. Well, you're still practicing with the 10, and then don't leave that 100 in that account. It'll be temptation. Go ahead and take it out. So now you're taking your $90, and let's split that in half, right? So you got to pay yourself. You're going to put $45 into your midterm holdings. You're going to take $45 out, oops, and that's what you're going to pay yourself with. I don't care what you do with it. Pay down debt, take a buddy or your wife or your husband or whatever out to dinner, buy yourself something nice. Just pay yourself, right? Because if you don't, all that money is just going to end up somewhere else. So you have midterm holdings. This is typically like your spot account. Let's say you want to stick with crypto, then you can buy kind of your altcoins, right? Maybe good altcoins. Maybe maybe some of the new small guys. You want to try some. Are they IDOs? Not IDOs. But try some new coins out. See if you can get them in for the midterm, or maybe you got some projects you really like, and that's more my speed. I like the ones that are more established, the Chainlinks and the Matics, even Cardano at this point. It's a really tempting price. Buy more XRP, it's cheap. I would call that midterm holdings. And then, well, honestly, for me, even Ethereum and Bitcoin, I don't have any Bitcoin at the moment, I don't think. But yeah, even Ethereum and all that, those are midterm for me. I'm not a huge believer in the long-term crypto investment simply because, and it's nothing against cryptocurrency, it's simply because it's based on technology, and an investment based on tech, it'd be like having all your investments based on music CDs, They were really, really hot stuff back when they were popular, but now they're obsolete. And all technology eventually becomes obsolete. Bitcoin and Ethereum, they're all going to do the same thing. They're all eventually going to get replaced by some other technology. So I don't consider them long-term investments. For me, they're midterm holdings. And I can hold them for a few years, still midterm. Long-term investments, this is where you put your money until you're ready to retire, or until you're ready to die. It's just a great place to hold equity. And for some of you guys, it's going to be Bitcoin and Ethereum. For me, though, it's things more like the S&P 500, bonds, and maybe a few select stocks, some mutual funds. That's where my long-term investments end up going. Maybe if this real estate bubble ever pops, get back into real estate. But, it's a whole other beast. Anyway, start here. Take 50% of your profits that are over your trading amount. That's my recommendation. You can do what you want with your money, right? I mean, I don't really. I can't tell you exactly what to do, but I would recommend you take 50% of that, put them in your midterm holdings, the other 50%, pay yourself. And then when your midterm holdings start producing, right, and you're up, treat it like a swing trade. Take some profits out and move them over to long-term investments. And you just leave that stuff there. Like midterm holdings, you want to buy when it's cheap, and you want to sell when it's expensive. Long-term investments, you just buy it and leave it there. It doesn't matter what cycle the market it's on. Dollar cost average in, and then when you're ready to retire, dollar cost average out. And it should be good then. Planning your trade. So now we've got kind of our account, and actually let me touch on this one more time, the short-term trades, because at some point you're going to want to graduate beyond $10, right? Because it's hard to make meaningful money on $10. So once you get the hang of it, and you stop losing your $10, and you find you're winning more and more often. And I know that $3, $2 at a time seems silly to be fighting so much for, because you guys are really going to fight for that $2 or $3 in the beginning. You just really are. Once you start seeing success over and over, week after week, and you know what a good entry looks like, and you've got your exit planned out, put a zero on there, right? That'd be my recommendation. Move from $10 to $100 and test the water with that. If you can trade the same way with $100 that you traded with $10, that's golden, right? That's good. If trading with $100 is nerve-wracking and it drives you crazy and the stress is eating up your trades, cut it in half, try $50. If that doesn't work, cut it in half, try 25. If that doesn't work, go back to 10. There's no shame in that. Trade that $10 until you can move the zero and be happy with how you're trading. Likewise, you trade $100 long enough, you feel comfortable at 100, or if you had to cut back to 50, trade 50 until you can move to 100. Try the 100 again. You're comfortable with $100, add another zero. Right now, you're trading with $1,000. You should be able to trade that $1,000 the exact same way you traded 10. Okay, this shouldn't be any different. $10, $1,000, your trades will be the exact same. And just rinse and repeat. 1,000 is too much, cut back to 500. If that's too much, cut back to $250. That's too much, cut back to $100. Do it until you're comfortable, and then add another zero. And you're trading with 10 grand, and you trade that 10 grand the exact same way you trade $10. All right, that's exactly how you should be progressing. And I don't have a time frame for you, but all I will say is don't rush it. Don't trade with $10 for 3 days and jump to 100, and for 3 days, and jump to 1,000 for 3 days, and jump to 10 grand for 3 days, because you need to experience the different market cycles. Doing it for a few weeks, slowly progressing over the course of a few months. If you're trading with $10,000 over a few months, that's pretty quick. Okay, that's rapid pace, because 10 grand. I don't even want to say it. I don't even want to tell you, because it'll get you excited, and we don't want to get you too excited. We don't want you fearful. We want a healthy dose of fear, and we want a healthy dose of optimism, not excitement. Try your best to keep your emotions out of the market. All right. So now we actually are moving on to planning the trade. And this is another area I think that is really, really difficult to do. This is where we're going to get into some technicalities, because planning your trade before you place a trade seems like a no-brainer. A lot of people will, however, jump into a trade before they have all of this sorted out. You need your entry, right? Let's say we hit resistance here and you wanted to short. Well, you're going to need your entry. We're heading up this direction. We hit your resistance. It starts to turn around. All right, so you planned your entry. That's great. What's your exit? And that is more than just where your take profit is. It's your stop loss as well. Is your exit your first one? Is the first one you should consider. So where's your stop loss at? Is it up here? We got another level of resistance. Okay, so our entry is here upon rejection. Say we take it there. Our stop loss is here, and that should be the amount of money that you are willing to lose today. Always assume your stop loss is going to get hit. All right? You need to know how you feel about that stop loss before it gets there. Because if you were counting on doing this, and you took your, this is a bad example. Let's say you were trading down here, right? And you're, I'm going to go long, and it comes up. Your stop loss is here, and you see it come down, right? And you're just watching it rubber right here, right above your stop loss. You're like, oh my God, I'm going to lose my money. And it comes up and teases you, comes right back down to it. You may bail on that trade simply because it looks like it's going to come after your stop loss. And if that's driving you crazy, if the thought of losing that money on that stop loss is driving you nuts, then your trade is too big. If your stop loss is in a good spot, it doesn't mean your stop loss is too loose, because Because if you planned it to have your stop loss right here or right here, above resistance or below support, your stop loss is good. That's a well-planned stop loss. The problem then isn't your stop loss placement. At that point, the problem is the size of your trade. You put too much into it, and I'm sorry, you should have known when you put that stop loss in that that's what you were willing to lose. There are other ways to cut a trade too, and that's my 2 candles and you're gone, and that's what would have likely happened here. It hit support. 1, all right, enter trade on this candle. 1, 2, look, it's not moving the way you want it. You want it to come up, and it's doing this. Get out, right? What time? This is a 1 hour time frame. You have 2 hours. 2 hours for it to move, and it's not moving. It's not going the direction you want it to go. It should be doing that. It should be doing that within the 2 candle closes. So, yeah. That for me is an exit as well. But that's part of planning, right? I know that's part of my technique. It's part of my plan. So I'm not going on the fly for that. That's something that's set in. Taking profit too, right? So we go along. Let's say we're expecting it to come up. Let's say we have some resistance above here and here. We could either do a partial take profit there. We could use that to move our stop loss. Either way, works just fine. Comes up, take another profit there. Maybe this is the exit. Maybe this is the exit. But you need to know that, right? Before you place that trade, you got to know where your target is, and that way you can evaluate. Like, if this is where you're thinking about going in, this is where you're thinking about going out. If this is your target, and this is your entry, and this is your stop loss, that looks like a good trade. But if the next support's down here and that's your stop loss, that may not be such a good trade. Let me take a look at that. Oh yeah, that's 50-50, right? You could lose or earn the exact same amount of money. Well, then maybe you're tempted to say, okay, well, if that's the case, maybe I think it's going to break up above all of this resistance and keep going. But that wasn't part of your original plan. And to me, that's sloppy trading. Don't maybes it. Just, if it's going to go where you think it's going to go, it's either a good trade or it's not. Afford yourself the right to be wrong and still be okay, right? You don't have to take the trade. You don't have to take every trade. In fact, you shouldn't be taking everything that looks like a trade. You want to be taking the ones that look like sure bangers of a trade. You want everything going the right way. You want it looking really good before you start throwing money at it. Okay? Not everything is a trade. So then there's trapping the trade, and that's kind of where it doesn't matter what the price is or what direction the price is going. So here we go. We come down. Down, up, down, continuation wave, right? Early entry, late entry, super early entry. If you looked in and caught an M there, that's fantastic. Okay? Price came down, and we're looking for that rebound, continuation. Well, what if it doesn't? We've hit double bottom, and it goes up. You have a plan for that? You need a plan for that. For up, you need a plan for down, and you need a plan for this. Because it likes to do that. So, what's our entry for the continuation wave? Say maybe because we're doing the third continuation, and we don't know, because I don't have levels on here, but let's just say there is a strong level of support right there that we're sitting on, right? Well, if we're sitting on a strong level of support, and we just throw one in, horizontal line. Alright, so there's our strong level of support. Sorry, it's late. I'm starting to slur a little bit. A strong level of support. And let's say we mark our high. So now we've kind of got this little channel that we're tracking. And this is going to be our entry criteria. We break here on our support level, we're going to go short. We're going to go short to whatever the next level is, our target. If we bounce off of support, that's going to be our entry for a long, because we're already down here, okay? So we go long, and we watch this, because if we face rejection here, we're going to terminate our long, and it's going to come back down there, or break down here. And if it breaks again, we can go short again. But it all depends on what we're expecting, right? If we've got a third wave down from another, let's say this is up here. I don't think it was, but let's pretend price came down, came up, came down, came up, came down. And we know we've got 3 waves down and we're expecting a rise. Okay? We may not get it. Our wave count may be messed up. But we're expecting the rise, so you know, we're gonna be more apt to go long, because that's part of our plan, than we are to go short. But we're ready to go short if it breaks and continues down. And we'll just take the profit out at the next level of support. Now, if we're waiting for trend reversal on the 1 hour here, and we think it's going to come back up to there, well then, alright, so that's our target. And we needed to break this. So we could go long here, but because we're expecting to go long, and we're already down here on support, go long here instead. Because odds are good, you're going to have the same next level of support, or EMA, or whatever's down here, is going to be your stop loss. Well, it's a lot closer to here than it is to here. Okay? So face that in your plan. And here's why it doesn't matter where price is now and where it's going to go next. Not just because you can plan for both scenarios. In fact, you can plan for all the scenarios. You can do a miter take profit there and leave your stop loss as is, and say the take profit from the entry here, the distance is about the same. You take 25%, you've got 25% in profit, and you've taken 25% out of your potential loss, and you're at almost break even. If it comes down and hits your stop loss at that point, it's almost negligible. So that's another part of your plan, right? Protecting your profits, mitigating loss. It's got to be a part. So we've got entry and exit, we've got trapping the trade, and we talked about the trend. That's a trend reversal. Now let's say this is just one wave and we're expecting a down wave. Well, we're already here. Oh, well, you know, look, we had to establish this. If there was no support here, then that might have been the best you could do. In which case, we're coming down here and you're waiting for a break of this imaginary support level that seems to be holding, oddly enough. Anyway, you're waiting for a break of this support level to enter your trade and ride it down. And you can put your stop loss, honestly, you can put it just above this green line, because if it comes lower and starts to come back up, well, now you're risking a W formation, and you don't want to get caught in a short with a W formation coming into play. But all that needs to be in your plan before you take that trade. Plan for all the different possible directions, and when you do that, it no longer matters where price is or where it's going to go. You've got your trade trapped. Alright, we had a nice M up here, okay? Let's talk about trapping that trade too. And I've not got any fancy indicators on here. This is basic stuff. Okay, so we came up, we came down, right? There's our neckline, right there. There's RM forming. You know, if we try to get in early, we come back, and yeah, we probably got stopped out. Unless you were looking for a larger swing trade. How big is this? You know, it just depends. Look, there's no shame in getting stopped out either. Look, because if you get stopped out up here, you know, it came up, stopped you out, kind of faked out there, came up, and say you zoom in here and it's got a little in, you can take another entry, right? If you rode this stop, if you tried to get in here and it came back and stopped you out, you can re-enter up here, you know, off this tiny little limb. And I know there's one up there. I can kind of see it. These are hour candles. Oh yeah, I can totally see it. Out of 15, it'll shine. So if you dropped into a 15-minute chart, you played that little in, that one came down. Well, you got a better entry. So the money you lost here and here, you're already making up for it up here. It's as if you took your entry here and it went your way anyway. All right? In fact, better yet, because your stop loss is up here, you're more protected from loss at that point. So it's one of the reasons I don't like to ride the stops. I'd rather get stopped out and re-enter in a better position, a stronger position. Comes down, does all this mess. What do we got, right? So if we didn't take a partial profit there, which coming down from way up here, you know, you probably should have taken a partial profit there. And it comes back up. Well, you're not getting stopped out unless you move your stop loss into profits, in which case, don't complain because you made money. Don't worry about where price goes after you exit your trade in profits. Stop doing that too, because that's going to wreck your head. Look at that. Continuation down. It worked. All right, but yeah. Take your money, and anytime you make a profit, that's cause for celebration. Every time you take a profit, cause for celebration. You should be making money, and it doesn't have to be big money. Make money consistently, right? Don't look for moon shots. Not everything's going to the moon. Not everything's going to zero. Not every move is going to be a big move. You can take much smaller profits and be perfectly happy if you can do it over and over and over again. Consistency. Okay. So we have a new neckline, we have a new entry, came up, broke this neckline. This is a much bigger M. This is coming down harder. You probably are expecting it there. Looks like we had a support level there. Could have take profit, exit trade. Maybe it's take profit, exit trade. Maybe it's just exit trade. It doesn't matter. That's up to you. But it has to be in your plan before you take the trade. So that wasn't really a trapping. That was more of a... That was more of a scenario of, you know, not worrying about getting stopped out if you're still looking for something to go. So let's say, let's change this a little bit. If I go into the 4 hour, it's just going to look different. So let's say we're here on the 4 hour. And let's say we're trading a channel. There we go. Got a nice channel going. We're on channel support. All right. We're expecting a bounce. We think this channel's gonna bounce. So we're looking at longing right here on support, and we want it to go up. What if it doesn't? Well, we got a stop loss. How far are we willing to let this go before we call this one a dud? Are we looking for the neckline? And that's a long way down. I don't know if I'd take that one. If it falls under here, I think I'd wait and see what it did at the next level of support. If it breaks the neckline, I think I'd short. If it starts to form structure like a W, I can go long again. Okay? But that's planning out ahead of time. It doesn't matter which direction it's going to go. It doesn't matter what the price is. I don't even know. What is this? H bar. I think that's H bar. It's 22.8. It's almost 23 cents. Doesn't matter. I can make as much money off of this, assuming I can gauge which way it's going. And it looks like it's respecting pretty well. Look at this. Came down, had a low, broke the neckline of the W, came up. Made an M. Broke the neckline of the M. 2 M's actually. Little M's inside. You could be playing this thing all over the place. Came down. Might keep coming down. I don't know. But that's just taking advantage of the structure. You got your trades trapped. You know how you're going to play it when it breaks one way or the other, or when it hits support, or when it hits resistance. And yeah, that's going to help. It doesn't have to be fancier than that. That's all you got to do. Trap your trades, plan your exits. And no matter what level of TA you're using, whether it's levels or arcs or price action or Elliott wave, as long as you've got a plan, you're going to be in a better position than if you didn't. So I'm going to wrap it up there. Just a little recap. Yeah, think about what type of trader you are. Try different types of trades. Get a feel for them. Get your account planned and underway. I can't stress that one enough, because you're not going to want to trade for a living for the rest of your life. It can either be stressful or boring, and neither of those are dream jobs. Eventually you're going to want your midterm holdings and your short-term trades to feed that long-term investment, so you can do whatever it is you like to do, or whatever it is you want to do, without having to nanny a chart the whole day, every day. And then, yeah, plan your trades. Plan your trades before you enter a trade. And you got to know that, all that criteria: entry and exit, stop loss, entry, take profit. And you may have multiples. And then you got to, have a plan. If you have multiples, start hitting take profits. Where are you going to move your stop loss? What direction is it going to go? Right? It doesn't matter. How can you trap a trade? How can you take advantage of price action? And it may not be immediate advantage of a turn. You may have to wait a few days, especially if you're a day trader, or especially if you're a swing trader. You may have to wait a long while. Like, maybe we misguessed the trend. And then trading the trend, right? So we saw the channel moving up. Well, if the price is continually forming higher lows and higher highs, and we turn here, it's still an uptrend. Trade that uptrend. You can make little snipes down at the bottom, but this is really on the uptrend. Longing on these supports, that's going to give you the best results. Quick shorts, longer longs, right? How do you identify a trend? You can use your trend lines, or you can just go by like the old adage: the lows are getting higher, the highs are getting higher. It's an uptrend, right? Play the trend until the trend breaks. It flips the other direction, and then flip the other direction and play that trend. And the trend is going to change. It's going to be a different trend. Sorry. It's going to be a different trend depending on what time frame you're looking at, and your trade's going to be different depending on what time frame you're looking at. So, know that as well. Trends only last so long. A 4-hour trend is going to last however many candle closes a 4-hour trend lasts, compared to a daily or weekly trend is just going to last a similar number of candle closes, just spread out over a much longer period of time. Alright, I'm exhausted. I'm going to go ahead and hop off this. It's gotten longer than I anticipated originally. Good luck to you all, and happy trading.